Many investment houses, the families would argue, are not seen as putting the client's interest first.
Running a family office is like running a business, but it's a more complicated business because it's also a lot of personal relationships which are involved.
Despite this professionalisation of the family office, you've still got to remember at heart it's a family business effectively, isn't it? Everyone's after the wealthy. Why? Because we all need to raise money for the burgeoning public sector in the West, and therefore you go after the people with money. So eventually that drives the family to make cleverer tax planning decisions.
I would presume that it should be love which glues families together, not money.
People don't understand wealth and think that many families are sitting there swigging gin on their big yachts. Many families have got their sleeves rolled up, creating new businesses. Setting up a family office is not for the faint-hearted.
Hello and welcome to Capital Horizons, the podcast where money meets politics. I'm Igor Yelnik. My guest today is Michael Oliver, co-founder of Global Partnership Family Offices. Hello, Michael. Very good to have you on the show.
Greetings. Thank you very much for inviting me. I'm looking forward to the conversation.
So, Michael, you know everything about family offices, and it seems like the industry has grown recently very much. Is this impression correct? And if so, what have been the drivers of this growth?
You're too kind. Unfortunately, I don't know everything about the industry, so to taper expectations. But certainly, we've seen a lot over the last 15 years since GPFO was formed. I think in the recent years, last 5 to 6 years, there's been a considerable growth in the top 1% of that wealth. And within that, family offices are growing super fast. Some figures say 300% growth alone in the last 5 years. And this is really significant. And I think any sort of intelligent listener, viewer will ask, why is that? Why does everyone want to start a family office, or what's led to this?
Indeed. Why?
Yeah, I suppose one of the key aspects is this lack of distrust of traditional institutions, whether they're banks, asset managers, wealth managers, so on and so forth. And they want to take control. As you know, Igor, if you're very wealthy, you want to take control. You can take control because you've got the money to do so. But there are, of course, issues associated with that, some which we can talk about. But therefore, why are they taking control? There's, I think, a sense of loss of control over their financial assets if they're just left with a big institution. In other words, many investment houses, the families would argue, are not seen as putting the client's interest first. That wonderful maxim from JP Morgan many years ago, put your client's interest first and everything else will follow, seems to be lost to numerous institutions, and few step into the shoes of a family office and realize that to gain the client, the family, will take some considerable time. Once you've got them, it can be sticky money. I think many families have felt over the last decade, even going back further than that perhaps, is that the price value equation is sort of unbalanced. They want a fairer shake. Why are they being charged so much fees for such poor performance when they could perhaps throw all their finances into an ETF and not have any worries? Passive investment is easier. We can come back and pick up on these points, I'm sure. And at the heart of this, for many families, is this sort of sales culture, sales targeting, dominating the banks and the asset managers, wanting to push product. And effectively, if you're an FO, you're sitting there constantly getting bombarded. You're seen as part of the bank's or the wealth manager's distribution network. And that seems really odd to them, and that they don't want to be sold to. If they are sold to and they begin to build a relationship with a client-facing member of staff, the frequent turnover of staff in those organizations also disillusions them. Why am I talking to this man or the woman, and they've worked with me and they've talked to me, and now they're suddenly leaving. They've got my investment, they've got my attention, and now they're suddenly leaving the institution. What's going on? And I think something else as well, which we'll come on to, is that family offices overall are becoming more professional, more quasi-institutional, certainly some of those bigger ones, and therefore they're able to run things themselves and do things probably better than many of the wealth managers that they used to employ. And linked to that, of course, is you've got your better informed inherited generation. People, members of the family have gone to Harvard or INSEAD or anywhere else, and they want to be part of the family office and bring to bear some of their expertise. And I think the final point I'd make is that the barriers to entry for family offices establishing have come down. I remember when we began GPFO back in 2009, some of the entry requirements were literally the costs of running the family. I mean, some of the big families do spend a fortune, many millions, on staff and systems and everything else, but those thresholds have come down a lot. So many people without the 700, 800, 900 billion are actually starting families with a lot less.
But what's the point in starting what you call a family office, and what's the difference between running a family office and just running money for a family?
Well, it is, what is the family do? What is the purpose of the family office? Whenever I meet a principal or a CIO working for a principal or CEO or whatever, I say, why have you established? What is the purpose of the wealth? And it becomes, I suppose, multidimensional. Many people talk about the family office as the glue that keeps the family office together, or the family together. Therefore, it's more than just an investment office. We can talk about investments later. Sure, it's the investment of the family wealth. We get that. But also it does other things, doesn't it? I already alluded to a training ground for family members. Perhaps it also looks after household administration. It might be there to actually start a charitable foundation, a seed capital provider, many different things. So this structure enables the family to use their resources in a much more focused way than employing bankers or accountants or lawyers to do it for them.
But this assumes that the family members, especially the senior family members, should have some knowledge in how to run the family office, how to run investments. And many families made their money in non-investment industries. Many people set up companies and sold those companies, and those companies were completely unrelated to investments. So people will not necessarily have a clue about how investments are done.
Correct. Or, just to add to that, they've made a lot of money out of, say, an e-gaming company, and they're experts in that, and they've got 700 or 800 million. And so they're experts on that particular area, but they don't know anything about emerging market fixed income on long only equities. They're completely ignorant of that. Why would they not be? That's their expertise. And therefore they employ the best from the best institutions. They might draw on JP or Goldman's or Morgan Stanley. And at the same time, those people that have worked at JP Morgan or Morgan Stanley, they might have been former clients of the principal, the matriarch or patriarch. They're suddenly working for this billionaire family, and they're very isolated. They become very insular. They haven't got the research desks that Goldman Sachs have, the publications they can draw from, the colleagues that they can talk to. It's a very different sort of setup to how they used to be in that big institution. So they need help. And the principal suddenly says, I got a problem. I'm running my portfolio historically using X, Y, and Z. And the executive will scratch his head and say, well, I don't quite know what sort of platform they should be using. Who do I turn to? And who do you turn to? I mean, that's why we set up global partnership family offices, is because families would come to us and share ideas of common concern, best practice, and all the rest of it. But you're absolutely right. Setting up a family office is not for the faint-hearted.
Okay. So I would assume that people make a lot of mistakes when sitting and running family offices.
They do. They do. They can get things wrong effectively. Just because you've got a lot of resource, or perceivably a lot of resource in terms of cash, to your point earlier, doesn't mean you're going to necessarily get it right. There's going to be mistakes made. Um, I think I mentioned the isolated and insular point, but also families can feel exploited. Why? Well, they're exploited because they're rich. They have a target on their backs. They have to separate the relevant insights, I would argue, from the promotional noise. How do they know what the best thing is to buy, to invest in, to consider? Insular because even though they've got a lot of money, they might have limited internal resources. They might only have one or two staff, and therefore resources can often be wasted when they're exploring new areas, new ideas that they think they ought to get into. And they're also isolated, I think, because their default mode of operation is secrecy. The challenge for them is to build those relationships beyond a limited number of trusted partners, often, of course, based on geography. So this takes time.
Yeah, speaking about geography, I think that people often face some changes in legislation, particularly in tax legislation, and the place where you make your money is not necessarily the place where you want to manage your money and to store your money, and it's not necessarily the place where you want your family to grow. Do such changes affect the functioning of family offices, their migration, if you will?
Very much so, Igor. And over the last 15 years, I've seen some amazing changes. Talking to principals, say 15 years ago, they're 15 years older. Their children are 15 years older. And 15 years ago, their children might have just been finishing school. Now they've been to university and they're now in the US. Problem. Or they're in China or Singapore or somewhere else in the world. So suddenly the families become, because of all the, let's call it globalization, a lot more separated. And this brings into, of course, all sorts of weird and wonderful issues such as tax,
Hmm.
domicility, where we do the investments, where do we base the family? I mean, within our own network, I know of many families that are, have the family business, if it's got an operating business, might be in parts of Africa, but they're based in London. And the son is in Dubai and the daughter is in San Francisco. So the world has become a lot more complicated. And of course, in terms of the geopolitics issues, which are massive, everyone's after the wealthy. Why? Because we all need to raise money for the, burgeoning public sector in the West. And therefore you go after the people with money. You don't go after it from the poor, you go after it for the rich. And therefore you start to target them with all sorts of weird and wonderful ideas. And of course, eventually that drives the family to make more sort of cleverer tax planning decisions, which of course then feeds the lawyers' fees and the accountants' fees and so on and so forth. But the rich have always been with us; they always will be with us. The world's just got a lot more complicated, but these complications can be overcome by clever people.
I can imagine a family which you described as an example, based in London, investments in Africa, somebody in the US, somebody in China. This creates a multidimensional planning problem in an ever-changing environment. It's not only the geopolitical environment which has been changing, and this includes sanctions on some countries which appear all of a sudden, but also changes in tax legislations which may change the whole setup.
Absolutely. I mean, and added to that, there's also the huge issue for families of cybersecurity as well, because it's not so much the cybersecurity guys are going after the criminals going after their individual family offices, but they're operating businesses. And because we've got much more knowledge about who's operating where, I mean, some families are completely under the radar and you've got no idea of their operations, but everyone has become a lot more transparent over the last 15 years. It's easier for these cyber criminals to go after the wealthy. When they've got 150, 200 million from their targets, they then disappear. That's all they're after. They're all after almost becoming sort of family offices themselves, these massive cybersecurity terrorists, I would call them. Um, but you've given an example there, I think, of, well, you've drawn on my examples. And because of this, and it goes back to an earlier question, when people talk about family offices, they can say, well, they all do the same thing. Well, they do in terms of growing wealth and preserving wealth, but how they invest, and perhaps we can turn to that now, is very, very broad and, like financial institutions, very different.
How do family offices invest? Does the investment style depend on the size of the family office, on the preferences of the patriarch, maybe on the history of the family?
I mean, they are all unique. And, the old adage, if you've met one family office, you've met one family office. People often say that. It's often unhelpful because there are some things that unite them. And let me give you just some examples. I mean, we've already talked about just generally those two I gave you, but let me give you two sort of case studies, if I can. You've got a family, an operating business in oil and gas. It's spilling out a lot of cash. So the family office has been established to use the dividends. So it still has an operating business exposed to commodity cycles, and therefore it wants to manage the cyclical risk, um, and wants to employ someone in house. So the macro risk there, of course, is renewable energy. They're slightly overexposed, perhaps in the MENA region. Maybe they have some safe assets in the US, They've got lots of listed equities, all jolly good, steady income streams coming in, superb property portfolio in London, and then they're thinking of setting up a university chair, say at Harvard or Stanford. That's an example of one family that we know. Another example would be a more modern family with a tech company exit, made the 700 or 800 million, exposed for different tax bills, but quite entrepreneurial. The family principal has children, and then they think they're going to allocate to private markets. They have a huge advantage, of course, in that if they want to go into the tech markets, but they want to diversify. They don't just want to keep spending money in an area where they've just exited. So they're buying assets steadily for dynasty trusts, property, commercial, residential, and they're considering philanthropy and impact investment. So a sort of a different approach to the first oil and gas family I mentioned. But in both of those examples, although they're very different, actually a few things unite them if you think about it. One, they can be patient investors. They're thinking in generational timeframes. And they don't have shareholders or investors to report to. They haven't got to report back and hit a performance target. They don't have to invest. The second sort of theme that unites them is legacy, isn't it? It's not just about the financial return. They want to have and leave a connection in both examples there. And then the final thing, and again, it links back to some of the stuff we talked about earlier on, is that these families are relationship driven. They're small teams and they want that personal touch, and they can do this in-house better than outsourcing. So every family office is different. And what we have seen over those last 15 years is despite that, they do have those same issues I mentioned. How do you grow wealth and how do you preserve wealth?
The breadth of the investments, which you have just described, which may be pursued by one family, is immense. I presume that it's a huge operational issue, and it's very difficult to cope with that. We have already discussed the change in environment and the change in taxes and so on. So how do families, especially with small teams which they hire, manage all that?
Yeah, it is. It can be very difficult indeed, can't it? And we've heard so much about, the growth of multifamily offices that take on board some of these activities for families. But
Basically, to achieve some economy of scale.
achieve some economy of scale, but a multifamily office, of course, could be made up of 15, 20, 40 families. And therefore, again, as a multifamily giving that single family office that's just joined it a fair shake of the dice. Is it actually focusing on the bigger, wealthier families in the MFO portfolio? The 500, 600 million families plus. Well, you could argue a 500 or 600 million family is actually doing it all itself. But that's why some family offices are very, very sort of specialized in what they do. And they know, we use that phrase in England, they keep to their knitting. They're actually focused on what they know in particular. So it could be, the big sort of holders, real estate, your fixed income, your equities. I mean, private markets we'll talk about shortly. But you're right, it can cause problems for families as they get larger and larger. And I think one of the key things I've seen, there's a couple of Swiss families that have got this problem at the moment, is that the family office is growing so quickly, they're having to employ different staff, and they don't actually have that time necessary to embed and work on what needs to be done. They're too busy acquiring and too busy growing. And that's a problem. So, then you might want to have a virtual family office and outsource rather than to an MFO or to a private bank, like Pictet have a sort of a private family office sort of outsourcing service. You would have a virtual family office service where you're buying in certain expertise from accountants, M&A, lawyers, blah, 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 and so on and so forth.
Yeah, and using such outsourced services brings you back to your first point about mistrust to financial institutions. Because eventually, if it's a big multifamily office and you are a relatively small fish there, then how can you expect that you will be treated as well as bigger families?
I mean, the question there for multifamily offices is how many families do you think you can manage, or should you be managing? 15 years ago, I remember having conversations with some MFOs as far afield as Australia. and they said, we've only got 2 at the moment, families on board, and we're only going to go up to 10 to 12 families. And I was thinking, well, that's quite a lot of families. Now I hear about MFOs managing 40 families.
40. 40.
40.
Wow.
And okay, at what point are they actually no longer MFOs, but effectively independent asset managers selling product to the families that they're employing and competing with the banks and the asset management companies more generally? It's a really difficult one to think through, isn't it? Yes.
Indeed. Indeed. So speaking about investments, I understand that each family office is different, but are there any common trends in how they invest their money?
Well, there are some sort of investment preferences and with that regional differences. Perhaps I can deal with the regional differences at first, if I can. I mean, I've always noticed since I've been working with families for the last 20, 25 years, is that the US is much more professional. In a funny sort of way, it's a lot more transactional. Yes, very keen on doing deals and moving things forward. The UK market, the big money that sits here, what do families do? They might do 2 or 3 deals a year, but they're not doing deals every month. They don't have to. Yes, there's no need to. Now, of course, why do families want to?
But in the US, they also don't need to.
No, they
Nevertheless,
don't.
Is it just part of the culture?
I think it's a cultural thing. I mean, you could argue, why are they doing this? Why do families need to do so many deals or so much investment? Well, look at the size of the family that's growing. We have a whole series of people in the family that probably need dividends, what we call them trustafarians, that sit there wanting payouts. Therefore, you need to actually improve your performance, don't you? In the last decade, as you know, Igor, until the last 2 or 3 years of low interest rates, the 8% return that you were expecting is no longer there. Therefore, what you have to do is to go after markets that you're more unfamiliar with, and certain investments that you're more unfamiliar with, in geographical regions. So hence, there's been a lot of interest in Southeast Asia or India. Huge markets, huge potential, because if you think of India, the mass growth of urbanization, which is just starting effectively. I mean, that's a massive area with a young population, whereas the West, of course, with its bust social welfare systems, its higher tax rates, is not that attractive. To be sure, America always comes up with some entrepreneurial spirit and manages to reinvent itself. But a lot of Western Europe, to me, looks very, very tired. And surely, if you're a family office, you're looking further afield for better returns than Europe. I think what I have seen is a big shift to alternatives. And families have these long-term investment horizons, which is what you've suggested. And with that improved professionalization within the family office, they're much more comfortable about going in away from public markets. They'll still do that, into these private markets.
But private markets can be very different. I mean, you can invest in real estate, you can invest in private equity, you can invest in hedge funds. In your view, is there any specialization, any preferences which each particular family office may have? For example, one family may say, I don't do hedge funds, I only do, let's say, practically venture capital, and they become their own venture capital fund. Or some people will maybe invest in private equity funds, but in nothing else. Or I know people who invest in hedge funds primarily. Apart from personal preferences, what drives these choices, and how do you see these choices change over time?
Very good question. I mean, I remember, 10, 12 years ago, we had one family that had about 80% of its portfolio in a traditional asset class, if you can call it an asset class, gold. Or one family had 90% in real estate and struggled to pay the credit card bill each month effectively. So, you've got those traditional things as well. But I mean, we did a research report back in September. It was quite a long process of interviewing many families and putting it together. And what we found, and again, we talked earlier on about you've met one family, so you've met one family. But what we found is that in the portfolios, it's almost over 50%, and looking to increase this, emphasis on private markets. So here, why you asked why they do this? Well, families can use their expertise, whatever it is, if it's in hedge funds or it's in tech, with a closer connection to the investment rather than going through public markets effectively. And to specifically address your question, why? Well, return potential. private equity in some market conditions can offer higher returns compared to public markets, can't it? It's clear from our research that we did. That's the primary reason driving family offices to invest in private equity. Portfolio diversification, you've touched on that, Igor, earlier. Well, PE provides less correlated returns and exposure to companies not accessible through those public markets. And of course, that then enhances the overall portfolio risk adjustment performance. And we've already said families have this long-term investment horizon. This patient capital often aligns with PE's typical 7 to 10 year investment cycles, allowing that deeper value creation strategies and so on and so forth. Now, that's not to say liquidity isn't also a barrier within that. And then you mentioned it just now with all those different things you listed. It's sector specialization. You've got emerging sectors like tech, healthcare, sustainable infrastructure, defense, security, space. I mean, these are particularly attractive because they offer one transformative sort of investment opportunities. And secondly, that gets them away from the traditional market segments, which they might and still do have an exposure to. But this is exciting stuff with the potential, going back to the first point, of higher returns, which they need clearly to grow the family to pay the trustafarians.
Yeah, I'm not so sure that everyone will agree with you about the private equity bringing better returns than public equity. There have been numerous studies showing that this is just not true. But I understand that, everybody fights their corner. Not necessarily all the research shows the real situation. But it's quite interesting that you believe that people are willing to harvest this illiquidity premium, basically to get paid for the loss of access to their own money.
Well, indeed. But I mean, to just drill down a little bit more, I'm not saying, and no one would expect me to say that this is risk-free. Just because there's been a growth and a move towards private markets, the risks associated with it are clear, aren't they? I mean, you mentioned liquidity risk. I mean, you've got capital locked up for extended periods, 7 to 10 years, often more. You've got limited secondary market exit opportunities. That's maturing. You've got potential, and we saw this 2 or 3 years ago, potential capital call timing misalignment with cash flow or portfolio needs. That was an issue for families at the time. You've got the economic risks, very sensitive to economic cycles and the interest rate environment, geopolitics, regulatory uncertainties. We touched on that earlier. And I think, more generally, more recently, there are concerns about relative oversupply of capital to the asset class itself. What does that cause? Inflated asset prices and potentially depressed returns going forth. These are all sorts of issues. Not only that, with co-investment and everything else. I mean, families, it's a minefield for families that are uninitiated. It's not the elixir that many people probably expected it to be, but this is the trend.
Speaking about co-investments, this is the term which many people understand differently. So tell us about co-investments, please.
Well, there's many different ways of looking at that. It could be co-investments with one or two families. You might have a grouping of friends that you invest with, you've historically invested. It might be actually co-investing through a particular industry body that's helping you. Then the issues become of, fees. What you're expecting to pay? That's one issue. Who's going to be the leader? We talk about co-investment, but if you've got Alpha 1 family and Alpha 2 family, who's going to be the leader? Do you go with the family that's got more expertise in this particular area? Just because a family is an expert in this area and wants to do the co-investment with another family, does the other family believe that family A has done its due diligence? Is it going to be a replication, or are you just happy with what's been done? So co-investment is, I think it's a growing area. It's always been there, but it's becoming ever more interesting.
Yeah, but if you invest alongside your buddies simply because you like doing business together, I understand that. This is like true partnership, and I understand how it works. When you have a leader to whom you pay, then what is the difference between this type of co-investment and a private equity fund, where you have professional people doing investments for you. They get your fees, and I mean, basically, it's the same thing.
But you're right. But doesn't it go back to the points that we discussed earlier on, effectively, that you feel as a family, the group of families doing this, you've got more control over your financial assets than going to a KKR, a Carlyle, a BlackRock, whoever who is actually doing the deal with you, or a Goldman's. You actually feel that you've got more skin in the game than they have. Your point is well made, but back to those issues, why there's a growth in family offices, I would suggest that because they are also feeling better informed, and the barriers to entry have come down, they can actually do what the big boys do, and make it more personal to them.
Okay, interesting. And still, apart from illiquidity and all the obvious risks, is there anything special you can tell us about the risks which family offices experience when going illiquid, private?
Yeah, we're talking to some families about this, and for many of them, it's still early days. I mean, one of their concerns is, of course, and I mentioned it earlier, these capital calls that can occur effectively.
Hmm.
That's a big problem. They've invested in something, and they think it's all going to be, singing and dancing and working well, and management's good, and they won't be called upon to offer any more cash or anything else. And suddenly something goes wrong, and they're not used to that. And they think, crikey, this is like running my operating business I've just got rid of. I've got a new problem here. This is a big issue. I mean, Igor, to take what you do, you have seen many examples of this, I'm sure, in your own area of hedge funds, when families are actually coming together to run a hedge fund. And, they might be running a hedge fund, not for an absolute return of 25%, quite happy to do a very simple hedge fund, getting 7 or 8% a year. But they still have problems.
Yeah, absolutely. And this is one of my points also, and you made the same point. It's running a family office is like running a business, but it's a more complicated business because it's also a lot of personal relationships which are involved.
Exactly. And families falling out with each other, and families, and within the actual family office. If you think about it, if you've got a member of the family within the family office, son or daughter wants to do a particular deal, principal's not happy, they persuade the principal to do the deal, something goes wrong, you've got those tensions. It's, despite this professionalization of the family office, you've still got to remember at heart, it's a family business, effectively, isn't it, within that? So that can be quite unpleasant. And I've heard examples recently of conflicts developing because of that. Or, the daughter married to a son, married to a chap not related to the family, but this chap is pushing for a particular deal, and that produces tensions within the family office.
Can it also cause some tensions where the children don't really want to be involved in the family office?
Yeah.
Somebody may want to be a doctor or a teacher, and
Correct.
they're absolutely not interested in making deals.
No, absolutely correct. Absolutely correct. I meet so many family offices where this occurs. Where I was in Italy recently, in Milan, and I was meeting several families there that had, had operating businesses. They sold the operating business because the children didn't want to be involved. A son or a daughter, doesn't matter who, then ran with managing the family office assets, but this didn't attract the other children back to work for the family office, because they just felt it was like a new business in a different guise. It wasn't a printing business. It was now a money-making business, or just dealing with investments or something. And they wanted to pursue a career. You said about a doctor. In, I think one family I met, it was in teaching.
Mhm.
And one was a mental health specialist as well. They've got no interest at all. I mean, there is this assumption, and it annoys me so much, that people don't understand wealth and the creation of wealth, and think that many families are sitting there doing nothing apart from swigging gin on their big yachts. Many families have got their sleeves rolled up and are actually actively involved, either in the operating business or running the family office, creating new businesses, employing people, and generating wealth, not just for themselves, but for communities and societies more generally. Economic history is littered with these examples, effectively, isn't it? It's not governments that create wealth, it's the private sector. We seem to have forgotten that. So, yes, it doesn't necessarily cause tension that the daughter or the son doesn't want to go in the family. They might eventually want to come back in once they've spent, 10 or 15 years in their career in teaching or medicine or something else. But the family office is there, the glue that holds the family together, perhaps to encourage them to perhaps invest in a project that they would like to do. And therefore, they're slowly drawn into the family office over time.
Isn't it interesting that you basically imply that the thing which glues families together is
Sorry,
money?
you would?
I would presume that it should be love which glues families together, not money.
Yeah, and of course, but the root of all, money can cause a lot. The love of money is the root of all evil, I think. Actually, it is the other thing, you see. So there's two sides to that. Yes, but you still get these conflicts. At the end of the day, this is the problem, the tensions that arise in a family office, where you've got, and I see it many times, where you've got the matriarch and patriarch, in their late 70s, early 80s, still clinging on to the family office, still dominating the discussions, dominating the investment decisions. And you've got, the children in their 40s and 50s that aren't actually able to take over the running of the family office. No doubt there's love in the family, but there's no sentiment in business on that basis, is there? And that's the problem, that the family itself starts to have these tensions, which then spill over. And so very, very quickly, you can become unloving to your parents
Hmm.
and your other siblings because of the disputes.
Yeah. And this may be a very big problem, I presume.
It's often a very big problem. People say, you go from rags to rags by the third generation. 2/3 of wealth is dissipated by that third generation. Why is that? It's family disputes. Lawyers, they get involved. The lawyers, of course, rack up huge bills. It's in their interest to actually perpetuate their income streams, and the disputes can be rather deep-seated and go on for years and years and years and years, and the family becomes fragmented, and the family office becomes fragmented. Or you set up another family office rather than keep it together. So you'd have 2 or 3 family offices with more cost. There's no unity there.
Well, sounds terrible. Michael, I think we have covered a lot of ground, and I think you have revealed quite a lot of interesting things which people didn't know about family offices, but now they do.
It has been a great pleasure speaking to you, and you are right, there's a lot more I can say, there's a lot more I can't say, but it's a fascinating area. Family offices are a fascinating area. Thank you very much.
Thanks for listening. This has been Capital Horizons.
So if you would like to see or learn more about Capital Horizons, please subscribe below.
From Michael and I, see you next time.